Hello everyone, welcome to Fearfully Greedy. In today's video I will do a stock analysis of the retailing sector. I did one of these for the medical sector, so if you like this kind of content, also take a look on that one, and also like and subscribe, it really helps a lot. Okay, so I picked these 9 stocks, many from the United States, for Kroger, Costco, Walmart, and Amazon for the online. Then Europe we have Carrefour and Ahold Delhaize, and then in China we have Suning, JD.com, and Alibaba. Okay, so what is a retailer? A retailer, I wanted to do this once from first principles. So retailing is the business of selling goods directly to consumers. I'm guessing the best business, or the one we should regard as best, is the one that does that in the most efficient way for all the stakeholders. Okay? So, first thing that came into mind, this might seem obvious, what your client pays is usually what they think your service is worth. So, it's kind of your value proposition from the eyes of your client. They wouldn't pay what they pay if they could do better elsewhere. So I think that's a good starting point. I think especially for retailing, size, scale, very, very important. Okay, so I started with revenues, but I said very quickly, I said this is off. This makes no sense. So I switched that to GMV, so gross merchandise value. Okay, I think that makes way more sense, and you will see we will adjust all the metrics to that. Okay, so in first position, Alibaba, over $1 trillion in gross merchandise value. Then we have Amazon, Walmart, JD.com, Costco, Kroger, and in much lower, Ahold Delhaize, Carrefour, and Suning. Okay, next I wanted to see how efficient they were in selling those. A thought that came into my mind was that how efficient your value proposition, or how good your value proposition is, could be getting the cost of what the client buys divided, for how costly it is to get it to them to serve that merchandise to the client. Okay, um, in a sense, if you have low gross margins but a small percentage of operating expenses later, I think that makes your value proposition in retailing very, very strong. Okay, little marketing, little overhead, all that. Okay, so first I took revenues, and well, surprise, surprise, we have Costco, king of the brick and mortar. Okay, JD.com is not far away, but funnily we see Alibaba and Amazon on the last positions. That's surprising. But very clearly Costco is on another league compared to the Walmarts and Krogers. That should be clear from this analysis. But then I said, let's adjust for GMV. How would we do that? So I thought, when we take cost of goods sold from the revenues, what getting that product costed. Okay, in a similar way we could do the same with from GMV. GMV is just revenue that we just don't account for it, and we just take a fee from it. Okay, so I'd say well, we have the part of cost of goods sold, we have this part from natural accounting, and then we take gross merchandise value, which would be total revenues. But we take out the revenues that we already have the cost of. So that difference is what the producer, the manufacturer, is taking home. Of course, when you have a marketplace, you don't expect the same margins, but in a sense, that's your cost. Like if you bought it from them and sold it to customers, that would be with the cost of the goods, of the total goods sold. I hope I made some sense to someone. Divided by operating expenses, how costly if it is for our company to service all that merchandise. Okay, and here we have a different story. Amazon goes close to the normal retailers in this value proposition ranking, but then we have a ridiculous amount in Alibaba and JD.com, this marketplace. So it's a bigger part of their business. And I think the marketplace, that might say something of that model, of the marketplace model. It seems very strong. If we compare the amount of merchandise we serve for the cost that we have to serve it, very, very strong. Okay. Of course, I'm in this channel with there to be wrong. Okay. If someone thinks different, please comment it, send me a mail. I would love to be wrong. I come from first principles, like knowing very little about retailing. Even in my daily work, I manufacture and I don't work with retailers. Okay, we do direct to consumer in a way. So yeah, I come from a knowing little and trying to learn a lot. Okay, so if you think something different or these numbers makes no sense to you or how you see it different, please comment. I would love that. Okay, then another ratio I would like to extract would be the marketing expenses. How much we have to tell people that we're selling stuff to get you to buy it. Okay, we have top of the world Costco. Of course, this is with revenue, so we will switch directly to the GMV, but Costco marketing expenses, marketing budget for the year is zero. They don't advertise ever. And then we have the traditional brick and mortar that they have very little. Finally, if we just take revenues, we see ridiculous marketing budgets for Amazon and Alibaba and even JD.com. So let's just adjust for GMV. That's how we would do it. And the story changes quite a bit. So Amazon, well, at Holder Highs, they don't disclose it, so that's not disclosed. And Amazon is getting close. They still spend a lot in marketing. Surprisingly a lot, okay? And then we have Alibaba, which is going in between these retailers, these brick and mortar retailers that technically they don't advertise a lot. They spend most of it in price, in getting you a low price. So surprising, not not the least. But we see Alibaba, which is kind of turning into a monster. Okay, this is 5-year average. If we take a look at the last 5 years, we see Alibaba marketing cost percentage of GMV increasing. They are close. They are at 1% now. JD.com, they are more like constant, and Amazon ones are also constant. So Alibaba, I think they are starting to get some competition, and it's not as easy as it someday was. Okay. Next up, I wanted to break a not break an arrow, break a javelin. I don't know how you say it in English. For the physical store, for the brick and mortars. Of course, if you want to save, if you want to buy big cans of anything, like a lot of gallons of milk or whatever, having everything in one place makes a lot of sense. We don't spend so much in getting it shipped to our houses individually, so I wanted to, I don't know, bring to the physical store just one metric for them, so that would be revenues divided by square feet. So if we see here, again, this would be dollars divided by square feet. Those for retailers disclose those. All the other ones, Sunning doesn't disclose those, and all the other ones, you could say that they don't have any square feet, which probably wouldn't be true, wouldn't be right, wouldn't be anything. But they would be much less efficient if we buy big quantities. Okay, so we have Costco just running circles around these guys. So they take Kroger, they run circles here. Holder Highs, they run circles. Walmart, more circles. And they are on a league of their own. Like, how efficient is this business? Ridiculous, ridiculous. Okay, then one thing, the what came to my mind is we don't buy at Amazon to save versus Costco. We might buy because we find something that is not there. We might buy because it's convenient. We just click it. Next day we have it at home. So a very large base, very large number of SKUs. So a lot of items that we cannot find anywhere else. Very low delivery cost per dollar, right? So we don't need to spend a lot to get it home for free. I'm doing gestures with my hands because it's never for free. Um, but yeah, it's very convenient. They lose a lot in the just the shipping. And then they might have some competitive items like mobile phones, notebooks, and other kind of items that they have the same prices as retailers. How can we say? Because it's hard to value that. So the convenience, the large SKUs, the low price to get it home. How would we gauge who is doing a better job at that? Okay, and I think that's the customer. The customer will buy more from us if they think they are getting more value for their dollars. They wouldn't if they didn't feel it. If they weren't getting more for their dollars, they would buy in another website or in another retailer. So I think the more people buying at our stores, and if we could get like same customer increase on buying, or if they keep buying, that would be the best metric. But this is a good proxy. So I think revenue growth on the 5 years, this is total. We could see who has the best value proposition. I think it's a good proxy. Not the best, either not the worst. I think it's a good one. So we see Alibaba 540% revenue growth, JD.com 264% revenue growth, Amazon 232% revenue growth, and then we have Costco, which playing in the leagues of the physical brick and mortar retailer stores is getting very, very good growth in revenues even after 20 years. So it's great, great. Then let's put some value to it. Don't hate me for this, but you will see we're doing a price to sales. Why? Why is that? I think in retailers, we could go net income. That's what we would take home. Or we could see reduction in price, low margin, low gross margin. That's what the client takes home. Okay, so we can be sharing the profits, or we can take them all, or we can do a bit of each one. To compare those two, like how we had low gross margin and high net income, or net income positive, the gross margin negative, how would we do that? I think getting a valuation of price enterprise value to GMV just put things in context. Like all these businesses are operating at very huge scales, like very, very huge. So I don't think that's the perfect valuation, but it's a good comparison at least. Any of these numbers don't mean it's cheap, but it's a good valuation metric. Okay. In Amazon and Alibaba, I've taken out Amazon Web Service and Alibaba Cloud. Okay, so it's not included. We take a bit the multiple and the profits for that business, which in Alibaba is almost nothing, and in Amazon is quite a lot. Okay, and this is the price to GMV that we get. Okay, I'm not saying this is super cheap or this is super expensive, but in comparison, we have like 10 times. And you could argue Alibaba is a more efficient business. So I think there's a huge disconnect here in valuation. I also have it here where I rank them. So I took each one of the metrics that we have been checking, and for scale we have Alibaba at first, for value proposition, just as for GMV first, marketing fourth. They are still spending, but they are very close to the Costco's, very close to the Kroger's, very close to the Walmart's. Then store efficiency, of course, we have first at Costco, and this doesn't apply as we said before. Value perceived, highest growth. You wouldn't have highest growth if people thought you are expensive or not worth it or bad product. And then the valuation that we just saw. Okay, so a bit on the analysis. I think this will be a first part series. I want to leave these ideas that I had over the last week or last weeks on video, post it, think about it, and probably get another video out soon or pretty soon, or we'll see. Okay. Well, I hope you like it. I said I have another video similar to this for medical, and my plan is doing a few more. As more sectors interest me and I have more time, I will do those. Then what I did, something happened. I've been shopping. So I bought 40 shares of Baba, Alibaba Group. Not for the reasons of this video. Some part of it, I think it's a great business, but the valuation is ridiculous. It's too low at this point. We're getting a lot of other stuff. I might do a full investment thesis if it's the interest of a lot of people, but I think there are plenty of theses, and it just, jumping over 2 feet poles or whatever. I think it's one of those. It's just too cheap. Okay, so I bought 40 shares for 3,264 euros, and now it's making 13.2% of the portfolio. So you can see here the transactions. I did it in two, 2 days ago, one day ago and one yesterday. And the full position is this one, the 40 shares, which is, I'm already losing money because the market is seeing red. No one likes anything. Everything is falling. So guys, disconnect from the computers, take a break, come back in a few months and relax. Okay, if you have good assets, the world will be okay. Okay, so what I did to buy that is adding the 1,000 euros for this month, and also I want to come public on my 6th mistake on the public portfolio. That's the buying of Biogen. Who was calling me into biotech company? No one. I thought it was very clear. The thesis fell through. We had aducanumab approved, but not funded. At this point, it makes no sense to hold it because the pipeline could turn right or turn wrong. I think it's still cheap. I won't change my mind about that. I think it's still cheap, but I want to buy things that I think I'm more sure about, and then I want to hold for 20 years if nothing happens. If the business keeps performing, I want to hold them. In Biogen, I need things to happen for this business to be right, to be a good value, okay? So I sold for a total loss of 575 euros, or 20% of principal. Okay, this is the sell that was also yesterday, the total loss, and the portfolio sits like this as of today. Okay, so we have Warrior Medical, still the biggest position, the only good performer. Everything else is red. We have Shinoken, Naked Wines, Baba, Interrauli Edwa, another sad story for this year, and Rai International. Okay, first time I have red in the portfolio, like full red, and well, no one said it would be easy, but I will keep. I said at the beginning of the channel, I'm here to share my success and my failures. Like if it goes bad, I will still post and tell you about it until I give up. If I give up, then you won't see any more of me. Okay? Well, everyone, thank you for tuning in. If you liked it, please subscribe. Please like the channel, the video, and subscribe to the channel. It really helps a lot. It keeps me motivated. It's a lot of fun to make the videos, think about these things, and having some place to share them. Okay. Well, take care. Disconnect from the computers for a bit. Bye bye.